Hey, everybody. Good to be here today. My name is Brent Moore. It's time to manage an options portfolio. I'm joined alongside Mr. Ben Watson, who's helping me out in the chat today. Ben is not just a good friend, but he's also a market veteran and is very familiar with everything I'm going to be going through today. So as you have questions between Ben and myself, we'll do our best to get those answered. In fact, regarding what we're going to be doing today, uh, Ben is probably especially appropriate because as I've looked at our portfolio and what we've done in this webcast, I realized I've kind of left out a big thing in the few weeks that I've been teaching this webcast, and that is something I have not even talked about hardly is our index options. And Ben actually teaches a webcast on index options, which occurs right before this one. In fact, some of you may be coming from that webcast. So I want to touch on index options today in our Managing Options Portfolio webcast, in addition to doing our usual option management, looking at existing positions that we have in our paper money portfolio and talk about managing those as well. But I do want to focus on the role of index options. As always, you can always follow myself or Ben on X at Brentmore CS, at Ben Watson CS for additional content. Also, remember to subscribe to the Trader Talks channel, the Trader Talks Schwab channel on YouTube. And before we get into it, though, let me just mention that options do carry a high level of risk and are not suitable for all investors. The information today is for general informational purposes only and should not be considered an individual recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as the sole means of investment research. Paper money application is for educational purposes only. All investing involves risk, including loss of principal. And let's see, past performance of any security or strategy does not guarantee future results or success. Paper money application will not assign a short option position early, but that can happen in real life. So just be aware of that. And we'll be looking at individual trades today. None of these trades, of course, are recommendations. So what I want to start with is this. I want to talk about, in general, index options. I want to give you examples of using them in a portfolio. And then I want to talk about trade management. All right. So, when we think of options, they can be used, there's kind of three main categories we use options for: speculation, income, and hedging. Index options can be used for any of those. Okay, speculation, income, or hedging. So I want to give you examples here on that in our portfolio. And when I'm talking about index options, there's a variety of index options. Of course, I almost always start my webcasts by starting out by looking at the S&P 500, the SPX. Yes, no, you can trade options on the SPX. And just like we often use it just kind of as a measure of the market, the SPX. You cannot trade the SPX itself, though. It's not a stock, and there's no shares of the SPX. But you can trade index options on it. Similarly, if you want to trade options on the Nasdaq, you can go to the INDX, which is a index for the Nasdaq, or the Russell 2000. You could trade that. RUT is the symbol on that. There's others as well, such as the OEX. Most of these index options are what we would call European style options, though. In other words, there's two basic types of options out there. There's American style options, two general types of options. There's actually more than that, but two general types of options, which are American style options and European style options. American style options, for most of you who have traded options and are familiar with options, that's probably what you're familiar with. They can be exercised anytime up to expiration. Okay, including before. And that's why when we talk about short options, we always say they can be assigned early. Most of these index options are what we call European style options, and they actually can't be assigned early. Okay. These go all the way to expiration. They're European style options. Now, are there any index options that can be assigned early that are American style options? The answer is yes. The one that comes to the top of my mind are OEX options. So if I pull up OEX, and these are options on the S&P 100. These are actually American style options. And if I go to the trade, you can go here. Now, there's a reason why typically I don't show these in any of my classes, and that is OEX options typically have really bad liquidity, to be very honest. When I start looking at these and I look at the bid-ask spread on these, they're very large on the OEX in general. Now, you may find exceptions to this, I don't know, but just traditionally, generally, they're less liquid. So I'm not going to deal with these. They're American style options, but for the most part, we're going to deal with European style options. Now, the next thing with index options you need to know is they don't settle to shares of stock because there are no shares of stock here. Now, some of you are saying, well, I can trade a particular ETF or something that tracks an index option. Absolutely. And we have classes that teach ETFs, including Monday, 4 o'clock Eastern time. We have a trading ETFs class where you'll talk about some of these. But I'm not talking about trading ETFs. I'm talking about trading the option itself, okay? Trading the option on the index itself. Now, here's the thing. If we don't get shares of stock, because a traditional option that you're familiar with, a traditional equity option, when you look at that 100 multiplier, what that is telling you is, well, this is going to control 100 shares of stock. And if I buy a call option, it gives me the right to buy 100 shares of stock. That's not how these work. These are what you'd call cash settled options. In other words, what happens is at expiration, the difference between the strike price and the price of the option is settled, is just converted to cash. It's still with that 100 multiplier, but then cash changes hands, not stock itself. All right. So, question from Sharon. When you're looking at the stock, how do you know if it's an American? So individual stocks are going to be American style options. The index options, I mentioned the one exception that I know, the OEX, are going to be European style options. They don't label them that much, but for everything I'm going to be talking about today is going to be a European style option for these index options, okay? Now, and so let's move on, and so that's basically how they work. And I think rather than just telling you that, let's show you and actually do some trades here on this. Of course, we can go here and we can look in the SPX, and we look at this all the time. So you can do the NASDAQ, which is, the charts looked pretty similar to the SPX chart. Both have been pretty bullish. Both have been kind of flirting or perhaps just barely broken above some highs. But let's look at the Russell 2000, because I want to take this, for example, as one that looks pretty different, doesn't it? This Russell 2000 chart. It's not as bullish. It has not been as bullish from a technical standpoint as SPX or INDX for that matter. This has been a little bit more sideways. And when we're doing these options, if I wanted to take a very bullish stance, maybe from a technical standpoint, a trader would consider looking at things like trend and finding something with the strongest trend. But you can also use these not just for speculation of big moves up or down, but you can actually use these for income as well. Now, a lot of these most of these index options are pretty expensive. And there are some alternatives to them we'll talk about in a little bit that are a little bit cheaper than the traditional SPX options, for example, or INDX options. But another way to do it is you can do spread trades on these. Okay, so let's talk about a spread trade on the Russell 2000. And for this, I'm going to resort to technical analysis. And So I think a lot of technicians would look at this and say, hey, the chart has been pretty sideways. Would you agree with that? I'd say it's been pretty sideways. I mean, we're basically the same price that we were at in October of last year. It's gone up and down, but we're not really progressing far. And we probably have some, I think what some people would deem to be a little bit of resistance at around the, 2320 level, something like that. We got some resistance here. We're right below our 20 and our 50-day moving average. So here's what I'm going to do. I'm going to look to do an option here on this. I'm going to look to do a short call vertical spread on this. A short call vertical spread. This is a bearish trade. And I'm going to assume that this resistance is going to be, is going to hold here. Okay. So if you're bearish on this, and if you were to deem this resistance to hold, it may be a consideration to do a vertical spread on an index option for income. Okay. So what I want to do is I'm going to sell a call, and we'll look at strike prices, but I'm going to sell a call, and then I'm going to buy a call. I'm going to do a short call and a long call. And the short call, I want to be at least at where my resistance level is. And so let's double check and just kind of see if I can I want to get a little better view of what that resistance level is. That's right around 2320, okay? Right around 2320. So we'll look to sell at that price or higher in terms of our short strike. And by the way, there is a survey link in the chat. We always appreciate your feedback, folks. So feel free to click on that, if not now, at the end of the session, before the session closes out at least, and give us some feedback here. But let's do this short call vertical. This is an approach to doing income. It's going to be a spread trade. So when we start looking at these more expensive type options, it may make sense to do spreads, because when you get expensive options, things can get pretty pricey pretty quick in terms of losses here. So I'm going to go to the trade tab, and I don't want to forecast out too far. And this is the fundamental question you always have to ask yourself when you're doing these trades is, what's your length? How far out are you forecasting from, say, a technical standpoint? And I'm not willing to say here in terms of this class and this particular example trade that we're going to do, what we don't want to do, we don't want to necessarily forecast out 3 months worth of time, because it's more difficult to predict out that far. Now, there's some trades where we may do that, but for our purposes, I want to go maybe 2-3 weeks out in terms of our forecast and assume that we're not going to be going above here in the next 2 or 3 weeks. So let's go to trade, and I'm going to go out. Let's see, we'll go out into March, and you can see one of the things with these index options is there's a lot of expiration dates, right? A lot of expiration dates that we can use. We'll go out, this is about 3 weeks at a time, about 23 days till expiration. I'm going to go out 14 days, and let's just kind of take a look. Now I have a column for delta, and the delta column is telling us how much each of these individual option contracts are likely to move given a $1 move in the underlying stock. Well, we can also use delta as a means of kind of estimating. It's an approximation. It's certainly nothing perfect. Probability of this going in the money. We don't want it to go in the money, so we want to keep the probabilities lower. Now, when we say that, you may look at this and go, well, let's go as low as possible. In fact, we can add more strikes on there and go even lower. But we also need to bring in a certain income here, or else it may not make sense to do the trade. So I want something that most likely is going to expire out of the money. So what often we'll do, and in this class what we're going to demonstrate, is doing something that has maybe somewhere, now I want it to be above my strike price, above my resistance level, and we said that resistance level was, I think, 2320. That gives me about a 37 delta. I could go 23.25, which would be a 35 delta. I can go to 33 delta. Let's look at that. So what I'm going to do is I'm going to click on the bid price to sell that 23.20. I'm going to then go out of the money a little bit further. Now, these are more expensive options, so I'm not going to do a big wide gap here. There are already $5 difference between those. So I'm going to do 23.30 and 23.35. I'm going to go to my ask price. I'm going to hold my control key down on my keyboard and click on that 23.35. Now, why did I specify hold that control key down on my keyboard? Because if I don't, if I just clicked on that ask price, it would replace the 23.30 with the 23.35. That's not my goal. I want them both there. So we're selling the 23.30. We're buying the 23.35. Our delta is about 33, implying about a 67% chance this stays out of the money. And remember, this is going to settle to cash because it's an index option. But let's also look at, let's click on confirm and send and just kind of look at this. What's our max gain? What's our max loss here on this? Max profit, 165. Max loss, 335. That's not a ridiculously high amount of money, is it? And in terms of what we often think of, one of the downsides of index options is they can get expensive. This isn't too bad. Now, the RUT is cheaper than looking at something like typically the S&P 500, the SPX. But furthermore, we're doing a spread trade on this. Spread trades can help limit your losses there on this. Now, one last thing before we send this trade, and I am going to send this for our example trade here. I just want to double check 23.30, and I'm going to put this on our chart. Where's 23.30? 23.30 is right about, I'm going to draw a little line here. It's not going to be exactly at 23.30. We'll call that good enough. That line right there represents where we don't want, in fact, what I'll do is I'll make it red here, or I'll make it yellow. Okay, I think you should be able to see that pretty well. There we go. 23.30 is that's where we don't want this to go above because this is a bearish trade. That's fine. From a technical standpoint, that makes sense. Okay, that may make sense if you think the stock is going to stay below here. Now, I mentioned something about expense, and Wiley, you anticipated me. We're going to get to that in just a minute here, but we'll do an example looking at different options here in a minute. But on this, I just want to let's do this paper trade and put this in. So I'm going to go right here. Now, let's be careful. The mid price is 160. The natural price is 110. That is a pretty big difference. It may be a challenge to get filled at the 160 mark. So I'm going to move this down a little bit to try and increase our odds of getting filled here. And so what I'm going to do here is we'll put that in here. And I'm going to confirm and send. And then what I'm going to do is I'm going to send this. We're going to send this, and I'm going to put it in. Oh, I have my groups hidden, so I'm just going to put that out there right now. There, okay. Now, there we go. That's an example. That's the first example I want to show you. That was an example of something that was more on the income side of things rather than just pure a hedge, which I want to get to in just one sec. But keep in mind, if you just want to speculate and you just want to buy a long call on the NDX or something like that, because the trend has been going up, you can absolutely do that. You can still put in stop losses. Stop losses are not guaranteed, but there we go on that, okay? Now, let's go ahead and let's talk about a different way of doing things. And that is another means you may use for index options is as a hedge on your portfolio, a hedge on your existing portfolio. So if you have a portfolio one thing you may consider doing is beta weighting that portfolio. You just put a little check next to the beta weighting box. Put in what you want to beta weight it to, and I'm going to beta weight to this SPX. And we're going to think about this portfolio, and I'm going to look at my delta column here. It's around 31, roughly 31. Our beta weighted delta, what this is saying is for every point move in the SPX, we would expect, it's an approximation, our portfolio to move up or down about $31 worth of value. And you go, well, $31 isn't that much, Brent. Well, a 1 point move in the SPX isn't that much either. Look, the SPX is about $6,100. And so if we were to have a 10% move, which is a substantial move, but 10% moves are certainly not unheard of, and they are more often than not, there's a 10% move in a year at some point. Let's say this were to drop by 10%. That's about 610. Well, I'll be a little more precise. $613 or 613 point, I should say, move in the SPX. What's that going to do to our portfolio? What goes, well, times our delta. Let me just do this here. Our delta. Did you notice what I did, by the way? Little side note. If you click on that little anchor dealy thing right here, it keeps these titles in place. Our delta is about 31. So I'm going to take that $613 move, which would be a 10% move, multiply that by 31, and that's saying that's about $19,000. Okay, that's about $19,000. Well, that is a pretty substantial risk in this portfolio. Now, you may be comfortable with $19,000. Everybody's different. If you have a very large portfolio, $19,000 may just be, yeah, that's the risk I'm willing to take on this. If you have a smaller portfolio and you see something like this, you may go, I want to hedge my portfolio. I want to help protect my portfolio if it goes down. So we may consider doing trades that hedge will help in that case. So one approach to doing this is doing a long put. Okay, a long put is a typical type hedge trade. Yes, the short call vertical I put in earlier hedges the portfolio to a small extent because it was a bearish trade, but really, if the market goes down a lot, it's not helping us out that much. The thing with the long put is it can start out, and if the market goes down, the further it goes down, the more and more protection a long put adds to us, okay? So let's look at a long put here on SPX initially, and then we may look at some different possibilities here on this. So let me go to the trade tab, and I'm going to go to SPX, which I have here. And let's just go out a little. I'm going to go out a little farther on this. We'll go out about 50 days on this. Okay, so I'm going to go out here. I'm going to go out about 50 days, and I'm going to look to buy a put, and we'll look something in the 30 delta range. 60-10. Okay, 60-10. How much is that going to cost us? $6,500 approximately is what that is going to cost us. Let me just do this. I'm going to click on that. I'm going to right click and analyze this trade here. Okay, so I'm going to go to add simulated. Well, we're going to analyze this. We have this. Let me just see what else we have in here real quick. This up. Okay, here's what we got on this portfolio here. So this is great, and you can see this is the graph of a long put. The more it goes down, the more money we make on this. Okay, the more we make on it, which is great. That in terms of a hedge, that's what we want. But it also means that if the market stays kind of where it's at, it's costing us $6,500 on this. Okay, so let's do this. Let me look at my portfolio as a whole. So instead of single symbol, I'm going to go to portfolio beta weighted, and we're going to look at, let me just get rid of that and that. Let me just go down, and I won't do all these. I just need a little more room here. Let's go down to our SPX. Okay. Don't need that. There's SPX. Okay. Let's look at my portfolio with SPX and without SPX on here. Okay. That's my portfolio. Nice bullish portfolio without SPX on there, without adding the hedge on there. You can see it, the more the stock goes up, here's the stock right here, or the portfolio goes up, more the SPX goes up, the more money we make, and the more it goes down, the more we lose. And currently we're sitting at about a PL open of about 24,000. Well, let's look what happens once we add that hedge on there. Once I add that hedge on there, this is what it looks like. Did you see the change in that graph? Look at this curve right now when we have the hedge versus when we don't have the hedge. So it certainly adds a lot of protection, but my PL open on this right now is if the stock, let's say the stock goes up, or the SPX goes up, goes from 38,000, goes from 44,000 to 38,000. So that significantly changes things on that portfolio. Furthermore, if we have that hedge on there, this actually just kind of turns this portfolio from a bullish portfolio to something that's, my delta is basically neutral. I'm not sure, that may be too much there. So there are alternatives that we can use that are a little less expensive than just doing a full SPX option. And it's something Wiley mentioned earlier in the chat, and that is you can use an option called the XSP. And the XSP are the mini SPX options. The chart on the XSP is going to look almost identical to the chart of the SPX. However, this is 1/10 of the price of the SPX. So that would mean 1/10 of the protection. If you have a smaller portfolio, using the SPX is probably going to be too much in terms of a hedge. But using the XSP may be better. In the chat, Ben uses the analogy of using a sledgehammer versus a ball peen hammer or something like that. Well, for our purposes here, that SPX may be more of a sledgehammer when you're not trying to use a sledgehammer. Using the XSP, is a viable alternative there to that to give us less potential movement on this trade here. And so you just need to judge it by your portfolio, and we'll look at this. XSP options tend to be a little less liquid than SPX options, but they are, a lot of them are relatively liquid too, though. So that's not a disqualifying thing. It's nothing like that, those OEX options I was looking at there. So if we're trying to change our delta on this, if I were to use the SPX options, my delta went to basically zero. In other words, this portfolio that I wanted to reduce the delta a little bit on would go to essentially, instead of a bullish portfolio, to a neutral portfolio. Not what I have in mind here on this for this example trade. So let's look at XSP, and let's go down, and I'm going to do a similar trade, which we went out, I can't remember, we went about 50 days out. And in fact, let me do the exact same analogous contract here. We had the 60, we're looking at the 601 option, April 11th. XSP. And let me get rid of that. 601, April 11th. And let me click on this. You can see the liquidity here. You can see the bid-ask spread difference there. So doesn't seem unreasonable for our class purposes here today. If I click on this, now let's look at and then I'm going to analyze this trade. Now when I look at these, and I'm going to still beta weight this to the SPX, but let me get rid of that SPX, and let's look at our XSP. So here it is without the XSP hedge, and here it is with the XSP hedge. You see, it's still a very bullish portfolio. Now, if I want to do something intermediate between the two, instead of going all the way to an SPX option, or just doing one of these contracts, I can always do multiple contracts of this, and I could up the number here. And you can see how that changes a little bit. Did you see that shift? As I up the contracts a little bit, it's becoming less and less bullish, more and more neutral, the more contracts I do here on this. But for our purposes here, I'm just going to do the one contract. And so what I'm going to do here is I'm going to go to my trade tab. I'm going to confirm and send, and this is going to be a hedge on my portfolio. Let me send that option here. And it didn't fill yet. I'm going to incent this to fill. So I'm going to cancel and replace this. And it's at the natural price. I would think that should fill here. Okay, I may, for our purposes okay, there, it just filled. It was just a little slower. Now, when we beta weight this portfolio, notice it went from about 30 and change to about 27. So this does reduce our delta, but it doesn't completely give us a delta neutral portfolio there. So when you're doing these index options, just remember, you can do them for income. You can do them for speculation. I didn't really show you just a straight long call speculation. You can also use them for hedging purposes. So going forward in this class, and as we manage, we'll look at these going forward. But also remember, Ben teaches a class on index options every week on Wednesdays at, oh boy, let's see, 11 o'clock Eastern time. 11 o'clock Eastern time. So he goes more in depth into these, but I just wanted to introduce you to these there. So now remember, these hedges are long puts. So if you contrast the two trades we've done today, we added in a short call vertical that is going to be a positive trade, and we added a positive theta trade, and we added in a short a long put, which is going to be a negative theta trade. And because the vertical has two contracts, they kind of offset each other a little bit, and the theta impacts are going to be less than the large theta impacts on the hedge that we have there. Okay, so I want to look at questions and see if Ben needs any help with any, in terms of sometimes it's easier on the platform for me to show something than Ben to try and type it all out. And then I want to go to managing our existing portfolio. Okay, so let's see what we got. Let's see. Looks like you were helping George out there, Ben. I appreciate that. What if the trade goes beyond expiration? Remember, these are cash settled. So once we get to expiration, what would happen on this contract? Well, XSP has a 601 strike. Okay, so let's use this as an example here, everybody. We've got a 601 strike on this excuse me, I got a tongue twister there. XSP option. Right now, the mark is about 612, but let's say it goes in the money. Let's say it goes to, say, 595 at expiration. That is in the money there. How much is this option going to be worth? Well, I'm going to take the difference between the strike price, which is 601, and the price at expiration, which in our example is 595. That's $6. Our multiplier is 100, so it'd be 6 by 100, or 6 times 100, or a $600 cash settled difference there in there. In this case, in the terms of the long put, that would go into the portfolio there, $600. Now, we paid up front $670. So actually, if this went down to $595, it's not, and held it to expiration, it's not really going to help us out. In fact, we'd be losing money overall on that transaction. But the further this goes down, the more the help would be. The break even on this, what's our break even going to be for a 601 strike? 601 strike minus my initial cost, which is 670, is going to be 594 30. Am I doing my math right there? That's going to be my break even on that trade, not including commissions, of course. All right, so hopefully that helps. Now let's look at some existing trades that we have. And remember, just a reminder, we do have a survey link. Now, in terms of managing these, in fact, I'm going to go back to these. As I was looking at that delta, I wanted the total delta. I got out of my groups. You can, because if you're in groups, let me show my groups. I unchecked my groups there. So when I was looking at these groups here, and I wanted to see my total delta for my portfolio, I couldn't see it. But you can uncheck or the show groups, and that way you can see the portfolio delta for things such as the beta weighting, for beta weighting purposes. Okay, now, in terms of XSP, that is a short option, excuse me, that's a long put. How long am I going to stay in that? Well, I'm going to stay in it as long as I want that hedge in my portfolio. In terms of the RUT short vertical, we're going to manage it like other short verticals. For example, we have a short vertical on General Motors, and it's doing okay right now. It still has 16 days to go to expiration. Remember, on managing these options, you need to have at least 3 things in mind in terms of managing options. 1, if things are going well, where am I going to get out? 2, if things are going against us, when are you going to get out? And then also have in mind, what if it's like not, it's going okay, or it's just kind of going sideways, or is there going to be a time exit? And the time exit on most of these trades is when we get below 10 days till expiration, we're going to look to exit. Well, we're at 16 days, so we're not going to get out for those purposes. Is this going against us? Well, this is a short call vertical, similar to the RUT trade we just put in, but this has progressed a little bit longer. Are we still going to be with this? Well, GM, we have a 50-51 call spread. Well, let's look at GM and talk about management of this. Are we still bearish on this? Remember, we have the idea that this stock is going to stay below about $50. Does it still look like it's going to do that? Yeah, I would say so. I mean, for a trend trader, from a technical standpoint, it looks like there may be some resistance here. Now that can change in a day, so you need to use your own technical analysis and decide how you want to view that. But I think a lot of traders, a lot of technicians would view this as a general trend that's going down below moving averages. Therefore, for our purposes in this specific example portfolio, we're going to stick with General Motors here, okay? Because also, if we've made almost all that we can make on this, then we will, we may decide to get out. But we haven't made almost all that we can make. It still has about 15 cents worth of potential on this, and we started with about 30 cents. So we've made about half of what we can potentially make. Now, once we get up to 75, 80%, we'll look to exit this trade early for this class. For our trade management purposes in this class, when we've hit an 80% gain on a short vertical, we're gonna look to exit in this class, okay? So we're gonna stick with that right there. Now let's move forward. Long options. Here's one that is not looking so hot here. AMD. What do we got on this? We have a long put. It's more of a trend trade long put. It's bearish. Let's look at AMD and see, should we still be in this? This is a bearish trend. Well, it looks pretty bearish, the trend from a technical standpoint in terms of trend, but look what's happened. It's just kind of gone up. Expecting a bounce maybe at the moving average, hopefully for the sake of this trade. But we do have a stop in. Let's see where the stop is compared to this, because we don't want to lose too much on this. So let's double check that stop and see what we got. Stop at $8.40. What's our current price on this? Current price is at $9.50. So here's what we have. We have a trade that's kind of not going our way dollar-wise. We're losing some money on this. But the general forecast, I think, a reasonable approach is to say, this looks like it may bounce down from here. So from that standpoint, we may stick with this, but we don't want to lose too much. We're near a stop point. So for our purposes, let's let this run, see if we get the bounce, and that'll help us out. If we don't get the bounce, we're going to get stopped out pretty soon here on this. All right, so even though we're at a loss, I'm not going to cut the loss short right now. We've lost about 20%, which happens with options, to be very honest. Options are volatile and 20% losses occur. So we're going to stick with this trade, and we put the stop in where it is for a reason, and we're going to stick with it. Now, let's look at another one. Here's GE. This is a bullish trade. This is a long call. Still got 30 days to go to expiration. So no urgency probably to get out on this. Our PL open is minimal right now. Are we still bullish on it is the answer on this. So it's a long call on GE. Pull up GE here. Well, how does this look? I mean, I'm going to zoom in here. This is a long call. In fact, I added in a green. This is kind of our target area. This is our area to exit. And so we still have a ways to go, but nothing bearish on this. So we're going to let that we're going to let that run here on this for this class. Just remember, these are all example trades here. Okay. Johnson & Johnson. Let's look at Johnson & Johnson. Let's do another one, and then we may need to, we're going to have to quit after this one probably, just for time's sake. So Johnson & Johnson, what do we have here? We have a long call. We're doing pretty good on this. We've made 100% on this trade right now, which is great. Initially traded at 178, 375. We can certainly take a profit off of this one if we wanted to. Let's see what we got. Yeah, there we go. We could let this run. And so for our purposes, I'm going to let this sit, let this continue to run. We still have time on this, but it's certainly, I think a lot of traders could justify saying we've doubled on this. We can get out of this trade right now, close it out, secure that profit in is certainly a reasonable approach. But for our purposes, it's still looking bullish. We still have a little time. I'm going to let that sit here on this, and we'll probably manage that and look to get out next week, even if it still continues to look bullish. That'll be a time to get out. Okay, so coming up next, we got trading price patterns. So make sure you check that out. Trading price patterns. I want to thank Ben for helping me out in the chat. I want to thank you for joining me. Just a reminder to everybody, we talked about index options, hedging, income, speculation on index options. And then we also talked about trade management on short verticals and single options today. So long calls, long puts. Thanks for joining me, everybody. Have a great rest of the day. Bye-bye, everybody.